Good afternoon, everybody. Well, first of all, I just want to say thank you to FSM for giving us the opportunity to participate in this fantastic event. And obviously, a big thank you to all of you in the room as well for staying behind and for joining us this session today. So as you can see from the title of the session, we're going to talk about the art of balance. The importance of diversification, especially when it comes to investing in the US market. But with that said, diversification doesn't mean putting a chip on every single square. Diversification means trying to figure out which squares actually need chips in order for us to achieve our investment objective. Because as we all know, if we over-diversify a portfolio, it really won't go anywhere, right? So it all comes down to thoughtful portfolio construction, active asset allocation, and that's what we're going to focus on today. All right, let's start with a simple truth that we all learned last year in 2025. Nothing is ever as good or as bad as it seems. I mean, think about last year, right? When everyone was talking about US exceptionalism, right? Everyone was talking about it. But then what happened? The tariff shock came in April. US markets, we saw one of the largest sell-offs in recent years. But the right question to ask at the time was what could actually go right? Because lo and behold, US stock markets then experienced one of the fastest recoveries in recent years, reaching new highs by mid-year. And so we should always look at both sides of the equation. We should always try to challenge consensus and really seek a more balanced view. That's the mindset we should all have. Now, if we look at the current environment today, we think when it comes to the US outlook, it's actually one that's quite constructive. We don't think the US is going to enter into a recession. And actually, we think overall, US economic growth is looking pretty solid. We think it's going to stay above trend. We think it's going to stay above long-term average. And that's because of a number of positive catalysts, right? We have easier financial conditions. We have easing monetary policy. We have fiscal support, right, from the One Big Beautiful Act. And we have other positive impulses such as CapEx investments as well. We see that US corporate earnings are still very strong. And we see that balance sheets today are still actually quite robust. So it's a good environment to be taking risks. But let's not get carried away. We should look at the other side of the scale, the other side of the equation. We have to acknowledge that valuations in main asset classes, especially in equities, is still quite stretched today. In fact, a lot of people would say they're almost fully priced for perfection. We also have to acknowledge that uncertainty in trade policy and geopolitics remain very high. There are still a lot of unknowns out there. And of course, when we look at the US equity market today, after that tech and AI-driven rally in the last 2-3 years, US stock market today is more concentrated than ever. If we look at the S&P 500 index today, the top 10 companies account for over 40% of the index's market cap. And so what does this mean for investors? What does this mean for all of us in the room today, right? I think a lot of you feel it as well. You want to stay invested. You want to maybe take a little bit risk, have a risk-on stance in portfolios. But at the same time, you're a little hesitant or maybe even a little bit reluctant to lean into risk assets or lean into equities in a meaningful way because of the potential downside risk. And quite frankly, that's a major challenge a lot of investors are facing today, both individual investors as well as institutional investors. I mean, look at this chart on the screen here. Today, there are more than 7.7 trillion US dollars sitting in money market funds. That's cash waiting to be deployed, right, back into asset markets. For a while, investors were getting over 5% returns in essentially risk-free investments, right? So that's why this cash and money market funds started to build up. But we're at a very important inflection point now. All of this cash is waiting to be deployed. This wall of cash is facing imminent reinvestment risk? And I'm sure that's a question all of you guys are asking yourselves as well. How do I actually balance the risks and the opportunities, right? How do I actually participate in US markets, but do it in a way that feels a little bit more secure? Well, in our view, current juncture is a great environment to extend into multi-asset strategies. If we look at what happened last year, right, spikes in equity market volatility were actually very obvious and more often than not, very, very sudden. But what was interesting to note is that if you look at the chart on the left-hand side here, interest rate volatility as measured by the MOVE index, as you can see, has been trending lower. It's actually right now at the lowest level since 2022. And more importantly, if you look at the chart on the right-hand side of your monitor here, you can see that after a tough couple of years, the correlation between US stocks and US bonds are finally back in negative territory. That traditional inverse relationship between US stocks and bonds are finally back. What that means is that bonds' utility as a diversifier for multi-asset portfolios is finally back. Bonds are finally protecting balanced portfolios again. And that is a great setup for asset allocators. Because when you're making a bet on multi-asset, you're not just betting on stocks or bonds. You're actually betting on the relationship between the two asset classes. And what we see today is that it's a great environment to be diversifying across asset classes as well as across sectors in a given portfolio. And that really underpins the case for balanced investing. One more chart to bring it home. As we know, it's difficult to predict with certainty where markets will be heading. But there's a lot of things that we can infer from historical data. So let's take a look at this chart here. So what this chart is showing is the frequency of positive returns for an all-stock portfolio as measured by the S&P 500 index. So that's the gray bars in this chart here. We compare that to a 60-40 portfolio, a 60% stock and 40% bond portfolio. So that's the green bars in this chart here. And we're looking at data all the way going back to 1989, so a long history that we're extrapolating the results from. So let's first take a look at the bars on the left. You can see that in any single day, actually, whether it's an all-stock portfolio or a 60-40 portfolio, the probability of a positive return for either portfolio, it's kind of like a coin toss. Markets can go up as often as they go down. But what happens when you extend your investment time horizon? What happens when you stay invested for longer periods of time? If we look at the middle of the chart here, over the 1-year period, for both portfolios, we see an over 80% chance of a positive return. But what's more interesting to note is that if you look at the 60-40 portfolio, the green bars, you can see that across all time periods, the positive return in terms of probability of positive returns across rolling periods is higher than that of an all-stock portfolio across all time frames. Over a 3-year period, it's 91%. And over a 5-year and 10-year rolling period, it's actually close to 100%. So if you're feeling uncertain about investing during these kind of market environments, if you see both risks and opportunities about investing at all-time highs, a great way to improve your return outcomes is actually to diversify and to invest in a balanced portfolio. So how do we put all of these ideas into action? So here at JPMorgan Asset Management, we've been managing multi-asset portfolios for over half a century. We have the benefit of being an asset allocator in one of the largest banks and largest asset management companies in the world. What that means is that the research and insights and collaboration that we get is a tremendous advantage when we are building portfolios, in particular multi-asset portfolios. So a lot of you might have heard of JPMorgan. A lot of you might even know us, the multi-asset team, through our core offering, the Global Income Strategy. And today, we're very pleased to introduce you to the US Multi-Asset High Income Strategy. So US multi-asset high income, as its name suggests, is this portfolio that focuses on the US market. We're taking a multi-asset approach to investing here. And what we're trying to achieve and to deliver is an enhanced income in the range of 7 to 10% over the medium term. Now, as you can see from the pie chart in the middle of this screen here, we have a 60-40 stock bond mix as a starting point. That 60% allocation to equities has two powerful engines to it. Firstly, we have growth equities. We're essentially investing in a broad basket of companies with very strong growth as well as quality characteristics. We write cover calls on the individual names, which gives us income in the range of 12 to 15%. Now, of course, when you write cover calls on individual names, you lose a little bit of the upside. But what you get in return is a very strong income cushion that helps provide downside protection during times of volatility. Let's look at the other equity engine. We have an allocation to real asset equity. And this is a very valuable allocation that very well complements our allocation to growth equity. So what are real assets equity? We're looking at listed REITs. We're looking at infrastructure, transportation-related names, all of which complements our growth equity allocation very well. Because within growth, as many of you know, you typically don't get exposure to these kind of higher dividend, traditional, more defensive sectors as well as securities. And if you think about real asset equity, this is an allocation that gives you exposure to key structural themes within the modern economy. So things like data centers, things like electrical infrastructures, right? Telecom centers, healthcare facilities, just to name a few. And their cash flows are backed by hard assets, which means that they're able to deliver a very stable income stream in the range of 5 to 7%. And that, again, adds to the overall portfolio resilience. Now, if you look at our fixed income allocation in yellow, so that's the 40% allocation in the pie chart on the screen there, you can see that our fixed income allocation is what complements our equity allocation. Here, corporate bonds is a core component of that. We're allocating between investment grade as well as high yield bonds to get that, diversified exposure, balanced exposure, and to really optimize for risk-adjusted income. And with corporate credit, you're getting a yield between 5 to 7%. And so putting it all together, the US multi-asset high income strategy is constructed in a very thoughtful way and designed to really provide consistent income and growth across market cycles and with true diversification at its core. So I talked about this earlier, right? Diversification doesn't mean putting a chip on every single square. We don't want to just throw together a basket of securities for the sake of diversification. But rather, we want to figure out which squares actually need chips in order for us to build a well-balanced portfolio. So this table here, I think, has some pretty telling stats. So what this matrix is showing is the correlation between different asset classes. So if the boxes are green, it means that they're more highly correlated. And the boxes are yellow, orange, or even red, it means that they're less correlated or even inversely correlated. So let's focus on the first column there. If you just look at the first couple boxes, right? Within US equities, whether it's large cap versus small cap, or growth versus value, they're actually all pretty highly correlated, meaning that they all tend to move in the same direction. When they go up together. When they go down together. However, if we shift a couple rows down and look at real asset equity as represented by REITs, infrastructure, and utilities, and if you move a couple rows further down to fixed income, we're showing here investment-grade corporate bonds, high-yield bonds, as well as US Treasuries. You can see that the boxes are essentially yellow, orange, or red, which means that they exhibit lower correlation with equities in general. It means that as an allocation in a multi-asset portfolio, they can bring about meaningful diversification benefits. So, a key ingredient to long-term portfolio success, I would say, is income. Because a stable income stream can help anchor portfolio returns, and also provide stability during volatile times. And at JPMorgan Asset Management, our core philosophy is that income should come from natural sources of income. So with the US multi-asset high income strategy, if you look at the portfolio yield we're targeting, we're looking at a range of 7 to 10% over the medium term. Today, in the current environment, our latest dividend yield is 9.5%. Where is that 9.5% coming from? Well, half of it is coming from options premium. So I mentioned the cover calls that we write on individual stocks. That's giving us income in the range of 12 to 15%, and that's where we anchor. But the other half of where we're sourcing income is from a combination of equity dividends from our real asset equity allocation and also coupons from our corporate bond allocation. So it's a very diversified approach. We're not just relying on one source of income, and that's really important because that's what provides consistency over the medium to long term. And again, we're focusing on natural yield here. We don't want to pay out of capital. Why? Because capital is not secure. If you pay income out of capital, ultimately that could lead to capital erosion. So again, focusing on natural and organic sources of income in order to provide a more consistent and smoother income and return experience across market cycles. All right, just to put things into perspective, we're showing here how the US multi-asset high income strategy stacks up against single asset classes. So here, the vertical axis is the running yield of each asset class. The horizontal axis is the long-term volatility for each asset class. And you can see how US multi-asset high income just sits firmly in the middle of this chart here, right between stocks and bonds. So we are operating essentially with the risk budget of a core portfolio with a moderate amount of risk. And if we compare that to US equity, which is at the bottom right corner of the chart there, you can see that versus US equity, we're delivering income that's 3 to 4 times higher with 20 to 30% less volatility. So for a lot of us here in the room, right, we mentioned earlier, we're worried about uncertainty. We're worried about what could happen in markets. But at the same time, we want to participate in US markets. How do we do it in a more secure way? It's through a diversified balanced portfolio that has a very strong income cushion that will anchor portfolio returns. So just to summarize, just to wrap up, US multi-asset high income can really be used in portfolios in 3 ways. Firstly, as a total allocation. So we see this as a package solution, an all-in-one strategy that will help you to build a strong, diversified core. And secondly, as a tool for income generation. You can use this to generate income in the range of 7 to 10%. And today, in the current environment, we're looking at a dividend yield around 9.5%. And that's sourced from a variety of sources of income and all natural yield. And finally, if you want a solution that will allow you to participate in US markets in a more balanced and diversified way, US multi-asset high income strategy is a great way to do that. Because now more than ever, we do think that investors need solutions that will perform in a wide range of market outcomes. And so with that, I wanted to say thank you very much for your time today. Please do come check out our booth at the back over there. I'll be there. My colleagues will be there. If you have any questions, please do feel free to stop by. And thank you very much again.